Let's look at some examples of transactions and see whether these transactions meet the definition of expenses. And the definition of an expense is one that decreases assets or increases liabilities and leads to a decrease in owner's equity, but it excludes drawings. This first example shows or is paid $1,000 cash to reduce a loan. How does this impact on the accounting equation? We would decrease our cash assets by $1,000, so that part of the definition has been met, but it leads to a decrease in the liability, decrease of $1,000. There is no impact on owner's equity, hence it cannot meet the definition of an expense. It does not impact on owner's equity. Here is another example. Drawings of cash $2,000. The owner has taken cash out of the business for their own purposes. This would certainly lead to a decrease in cash, $2,000, and it does lead to a decrease in owner's equity because drawings is a negative owner's equity item. However, the definition of expenses excludes drawings. The definition of expenses excludes drawings. So even though it leads to a decrease in owner's equity, it cannot be an expense because drawings is excluded from the definition. Here's another example. We have bought a computer for cash. Let's exclude the impact of GST. It makes no difference to an expense. So we're buying a computer for cash. The computer, of course, is an asset. So what happens is there is a decrease in the cash assets, $3,000, and there's an increase in the computer assets, $3,000. No net change to assets, no effect on liabilities, no effect on owner's equity. So it does not meet the definition of an expense because it doesn't lead to a decrease in owner's equity. So it cannot be an expense. Here's another example. Once again, we've excluded GST. Paid $1,200 cash for advertising. The business has advertised its services, paid $1,200 cash. That would lead to a decrease in the asset cash, which is part of the definition, and it also leads to a decrease in owner's equity because advertising is an expense. So this transaction does meet the definition of an expense. A decrease in an asset which has led to a decrease in owner's equity. Advertising is not drawings, so it meets the definition of an expense. Let's just talk about GST quickly. Let's assume that the business pays, say, $400 GST on its rent. Could be anything, let's just say rent. Is the payment of GST an expense? Let's have a look. It certainly decreases assets. In this case, $400, cash assets down $400, so part of the definition has been met. However, in paying GST, the liability to the Australian Taxation Office has been reduced. The liability has been reduced, the asset's been reduced, there is no impact on owner's equity, so it does not meet the definition of an expense. GST payments are not expenses. There's lots and lots and lots of different examples of expenses. Here are just a few. Wages, rent, cleaning, interest on loan, depreciation of non-current assets, discount expense, power and light or power, insurance, advertising, internet expenses, bank fees, and there's many, many other possible examples. They all have one thing in common. They lead to a decrease in owner's equity and they are not drawings. So in summary, expenses work to decrease profit. Expenses work to decrease profit, hence they work to decrease owner's equity. And the relationship between profit and owner's equity is shown here because profit is transferred to the owner's equity section of the balance sheet at the end of the reporting period. So expenses work to decrease profit. Profit belongs to the owner, so expenses in effect lead to a decrease in owner's equity. And remember the definition of an expense: a transaction, a decrease in an asset or an increase in liability that leads to a decrease in owner's equity.